The Fed hiked almost as expected. But while hinting at a pause, Jerome Powell didn't quite confirm that rates have peaked. Also, he was optimistic that recession may yet be averted. To understand more, especially the impact on emerging markets, I have with me two eminent economists, Robert Sockin, the global economist at Citi, joining us from all the way from the United States, and Rob Subbaraman, head of global macro research at Nomura. Gentlemen, thank you very much for joining me. Rob Subbaraman, with your permission, I'll start with Robert. He has been staying up for us. Robert, well, the Fed seems to indicate a conditional pause. They didn't guarantee they will not hike. So what's your best guess? What are your projections of inflation, labor market, and hence, are you sure rate hikes have ended?
I think we think that the inflation prints are going to remain fairly strong over the next several months. So you're still going to have inflation running something like 0.4% month over month in those core measures, and that's probably going to keep a lot of pressure on the Fed to continue hiking at least a little bit more, especially if the labor market remains tight. It's not the best indicator of job growth, but the ADP employment report, for example, today showed a significant upside surprise. I wouldn't put too much weight on that, but I think it does highlight that you are still seeing a lot of employment strength. And there is potential for the labor market numbers to continue to surprise to the upside and the inflation numbers to continue to surprise to the upside over the next few months. And that's probably going to put some pressure on them to continue hiking. Now, of course, the other factor is the banking stresses. Our view is that, you're going to get some continued flare-ups and concerns about certain regional banks, but that the broader banking system remains healthy. And so you're not going to get an extreme tightening in lending standards as a result of this banking episode that started in March. And most of those effects on the economy will probably play through with a lag and probably won't be felt until later this year or early next year. So it's kind of a difficult balancing act for them. In the near term, we're expecting strong labor markets, strong inflation pressures, probably pushes them to do a little bit more, even though those banking stresses will probably tighten credit, they'll pull down growth later in the year. But I would say, even though we expect them to do a little bit more, the risks are certainly tilted towards them pausing instead of them having to do more.
Robert, just to persist with, hike or pause or cut, Powell did say it's too early to cut rates. So what's your best guess? No rate cut in 2023?
We don't have a rate cut, and I think that's an extremely important point because, as I mentioned, very uncertain about whether, we're at the terminal rate of this cycle or if the Fed's going to have to do a little bit more from here. We think there's a little bit more to come, but the balance of risks are certainly shifted to them pausing. But that being said, even if we are wrong and they don't have to hike anymore, and this is the terminal rate in this cycle, we have a fairly strong conviction that they're going to have to hold that terminal rate for a significant period of time. And so even though the market's pricing in cuts for this year, it's really hard to see that happening with the type of inflation pressures that we expect over the next several months and through year end. Our inflation forecast still has core inflation north of 4% by the end of the year, so even higher than the Fed's forecast. And that type of environment is going to be really hard for them to pull back on policy. And you saw that from Chair Powell today, even though, again, they threw away their guidance and said it's going to be meeting by meeting in terms of if they have to hike more. He pushed back strongly against the idea that the Fed would start cutting anytime soon. And I think, I take them at their word, given the pressures we're seeing, and that it's likely going to take inflation a while to move back toward the Fed's target. It's difficult with that macro backdrop to see them cutting rates anytime this year.
Okay. Rob, now, what did you take for an emerging market audience? Did you get the feeling that yields are not getting higher in the US and the dollar is not getting stronger? Is that what you would be telling your clients? Rob, I think you're on mute.
Sorry, can you hear me now?
Yes, please.
Yeah, I would say it was interpreted as mildly dovish because Jay Powell and the FOMC they've left the door slightly open, but they didn't strongly suggest that there's more rate hikes. They left some flexibility. And so I think that was taken by the markets as maybe they're done hiking rates. And that is the Nomura view as well. We think they're going to be on hold now. But as Robert said, it doesn't mean they're going to be cutting rates anytime soon. We don't have a cut until March next year. So I think we're still in a very uncertain period. And while the US data has been strong and inflation is still way too high, I think the risk in the coming months is the growth picture starts to darken. So growth starts to come off. The risk is we are going to see more credit tightening in the US. The risk is the debt ceiling crisis that's building could get worse. And so, when that happens, markets are going to be demanding the Fed to start cutting. And with inflation so high, I don't think the Fed's really ready to cut. And so that could be when the rubber hits the road, and it could be a bit of a negative situation for emerging markets when growth slows, but inflation's still high and the Fed's not ready to cut, but the market wants cuts.
No, I take your point that we could be in a sticky situation where inflation is not down, but growth has started to decline. I'm not very convinced of this debt ceiling drama. It seems to be brinkmanship, at least last time around. So let's see whether we have to blow it up in the media. But Robert, coming to this growth part that Rob Subbaraman is raising, Powell repeatedly said a recession may be avoided. He said a soft landing is not off the table. Do you agree that US can escape a recession?
I wouldn't put a zero probability on a soft landing, but I wouldn't put a particularly high probability on a soft landing. I think given the inflation pressures that we're seeing, especially on the services ex-rent side of inflation, a lot of that's driven by labor market strength. And it's been our view and continues to be that you need to see a significant softening in the labor market to really bring down those services ex-rent inflation pressures. So, it's hard for us to see wage growth moving down significantly in those sectors and price growth moving down significantly in those sectors without a significant softening in the labor market and some type of recession. That being said, even though we do have a recession in our forecast, we think it's going to start in the fourth quarter of this year. We think it's going to be a fairly mild recession. So most recessions, on average, a recession in the US tends to last closer to a year. We only have it lasting about 2 quarters. We only have the unemployment rate rising a little over 2 percentage points. Historically, the unemployment rate tends to rise about 2.5 percentage points in a recession. So we do think that even though you need a downturn likely to bring down these inflation pressures, we think it'll be fairly mild. Now, that being said, I think the banking stresses that we've been seeing over the last few months raises the risk of an even deeper recession than we have in our forecast. So even though we think our baseline of that mild recession is right, we put about a 2/3 probability on it occurring and a 1/3 probability that you get some type of deeper pullback in credit as a result of these banking stresses. And that's going to weigh on growth even more significantly than we have in our forecast and lead to a deeper downturn. And in that type of environment, we would expect the Fed to loosen policy more significantly than we have in our baseline. So I would expect if we have a deeper recession, the Fed's going to cut sooner and more than we have in our forecast.
I have only a 1/3 probability of a deep recession and 2/3 probability of a soft one. Well, Robert, I'll let you go on that note. You have stayed up too late for us. Thank you so much. But Rob, more questions for you. What does this mean for EM economies like China and India, which seem to be on a reasonable growth wicket? Does it look like if the US is battling between soft and hard recession, And here are India and China, which are talking of growth and better growth. There can be smart money moving more towards these EMs than developed markets.
I wouldn't say China's having a strong growth right now. A lot of it is base effects from the Shanghai lockdown last year. China, in our view, is having a bit of pent-up demand right now, particularly services. But, overall, our view is China's economy is not going to have a boom, and the recovery will start to fade in the second half. Overall, I would say we're still cautious. And when I want to talk about India, our concern around India is people are too optimistic on growth. Our forecast for FY24 is 5.3%. I think many have it around 6 or so. And the reason why we are below consensus on growth in India is because we think the export downturn is going to spill over into weaker capex going forward. And in addition, the tightening of monetary policy in India is also, with a lag, going to start to hurt growth as well. So our view is, in India, growth is going to disappoint. In line with that, we think inflation is going to come down more sharply than the RBI thinks. We think in the coming months it will be probably sub 5%. And that will set the stage for the RBI to start cutting rates before the Fed. We think the Reserve Bank of India will start cutting in October this year, with a total of 75 basis points of rate cuts in this cutting cycle.
Okay, let me just play, the other side. We've had a couple of positive macros happening. Inflation, I think, will be down below 5% as well for the coming, could be below 5% as well. And look at the way crude is working in our favor. And if you looked at the trade numbers, services trade actually is doing very well. And the Jan, Feb, March may even be a current account surplus. So if the macros in terms of yields, and yields have fallen today, the 10-year yield is below 7, half a percentage point below what it was on March 1st. For a complex of reasons, US yields falling, oil and good buying by insurance companies. So do you think there is a chance that the macros are actually improving and you may have to revise your growth projections up?
No, we don't think so. A lot of what you said, I think, is right. But don't forget, yields are coming down. But monetary policy works with lags of 12 to 18 months. So we're still, the tightening that's happened is still filtering through into the economy. And services, yes, India's services exports have been strong. But don't forget, with reopening of economies around the world, there has been pent-up demand for services and excess savings that's been wound down. But over time, that's going to fade. So we would say that's not going to last too much longer. And we would put more emphasis on what's happening ahead. We, like Citi, are forecasting a recession in the US in the second half of this year. We think China's growth is going to slow. And that's going to really constrain Indian exports. And we've found in the past there's a strong relationship between downturns in exports and downturns in capex, private capex in India. And to be honest, you look at capex in India, most of the strength is the public side. Private hasn't really rebounded strongly.
No, every bit of what you say is right. Just a last forecast from you. Do you think that the dollar has peaked and we may see it in double digits, the dollar index? Yeah,
so it will be, the dollar is very uncertain, I would say, at the moment. It's very difficult to forecast. If, the benign scenario of a soft landing in the US, i.e. no deep recession, and then the Fed and the market starting to anticipate rate cuts, that could be an environment where the dollar softens. And today, after the Fed meeting, we have seen the dollar soften a little bit.
Yes.
But, I still think there is a big risk that the dollar has another swing on the upside, appreciates further, because I do worry that we are going to see a deeper downturn in the US and the Fed not quickly coming to the rescue this time. And I think that could lead to a flight That will be bad for EM. It'll be risk off for markets, and I think it will lead to a flight to safety in the dollar.
Oh, yes, we just heard this morning, PacWest Bancorp, another bank, is kind of jittery and exploring strategic options. Yes, I don't have time to explore that, but I take your point that there could be a risk-off and strengthened dollar. Pleasure speaking with you, Rob Subbaraman. Thank you very much for helping us parse the impact of what's happening in the United States on emerging markets like India. We wrap up on Bazaar. Chartbusters up next.